Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, March 21st, 2017. In this video, I wanted to start out with a very quick overview on the broad markets. I've put out some fairly extensive coverage on the broad markets lately, and then I wanted to roll into more specifically, my own trading strategy, what I've been trying to communicate on the front page and a lot in the trading room recently. How I'm engaging this market, how I think it's best to profit in this market right now. It's been as far as the broad markets go, and I know there always seems to be a tremendous amount of interest. Everybody wants to call the stock market. Everybody wants to outgame the market. Well, again, I always say the stock market is a compilation of thousands and thousands of stocks. And you trade the broad markets, you're going long the good with the bad. If you short it, you're shorting the strongest stocks with the weakest stocks. So therefore, I'll focus, although I do at times will take a broad market position, a long or a short. Most of my trades are individual stocks and or sectors via ETFs, futures, or anything like that. So let's go ahead, take a quick overview of the markets, because everything I've been obviously pounding the bearish drums for a while now, and not only has my resolve weakened because the markets haven't rolled over, at least not to the extent I thought they would, but my resolve has only become even stronger as I look at the charts. Everything I'm seeing, I give you my word, it's not confirmation bias. If anything changed in the technicals or anything else, and I thought it might be time to abandon that view for a sharp pullback, I would communicate my thoughts as soon as possible. But again, all the bearish technical developments that I've seen and have pointed out in recent weeks have only grown larger. Sentiment is at extremes, market breadth deterioration, everything I'm looking at. And before I roll into the charts, and I'll touch on the broad markets real quick, I want to share my strategy, and I talk about this often, especially in the trading room. I almost at all points in time, I trade a long-short portfolio, meaning both long and short positions. And depending on market conditions, I may have more longs and shorts. That would be called a net long exposure, or I might have more shorts than longs. At this point in time, the longs that I'm taking, and this actually has gone on for weeks now. You can tell by the trade ideas on the front page, and particularly those in the trading room. That's where a lot more of the trades that I'm taking personally are posted. Many of those trades don't meet the criteria for official trade ideas, because I know there's all types of people. There's people that follow the site that trade professionally. They work in institutions. There's people that have been trading for many more years than myself, and there's also a lot of newbies, people new to trading, investing, and therefore a lot of these lower price speculative trades, high risk that I personally take and post in the trading room, they just don't meet the criteria that I like to post as official trade ideas. Because of the above average risk return. But I'm going to go over those, and the point that I'm trying to drive home here is the longs that I'm taking and have been for a while have very little to no correlation with the broad markets. Yes, the broad markets have appeared, or they have been tremendously resilient since the presidential elections in the U.S. Although, as I pointed out, they topped the beginning of this month. Today is March 21st, so we're 3 weeks into the month, and so that means the market is, in my opinion, 3 weeks into a correction. Some look at it the other way. I know there's a lot of calls for another big thrust up in the market. Maybe we get it, maybe we don't. But again, I haven't abandoned my call for a decent pullback / correction in the broad markets. So again, the longs that I do take have very little to no correlation into the broad markets. What I mean by that is I'm not going long the Apples and the Googles of the world, the Microsoft, the top holdings, because what I'm seeing here is, and I pointed out, and if there's time in this video, I'll do it, clear deterioration in market breadth, meaning fewer and fewer stocks, namely those mega cap stocks that I just mentioned, the Googles of the world, or Alphabet, Apple Computer, or Apple Inc., I'm sorry, Microsoft. Those have been lifting the market while the internals have been deteriorating. So therefore, that brings me to the next point. When I'm shorting the best looking setups, and I don't care really if they happen to be, components, larger mega cap stocks. For the most part, those aren't the ones I'm shorting. A lot of those are small cap stocks, mid cap stocks, and and keep in mind, there's that saying, and I tell you, sometimes this saying irks me to no end. You hear people say the old cliche, "The trend is your friend." Don't fight the tide. Well, guess what? When market breadth is deteriorating, in other words, when you have more stocks declining, fewer stocks making, the 52-week highs, more stocks making 52-week lows and 52-week highs, and things like that. That means there are a lot of stocks falling, even if the broad market's rising. That's what market deterioration is all about. So you can profit in a rising market as long as you're not shorting the broad markets, as long as you're not shorting Apple, Google, or Alphabet, Microsoft, Amazon, Facebook until they break. So again, my point is, out of that universe of thousands of stocks, there are always, at any point in time, attractive long and short candidates. And so, again, the longs that I short, if they are even stocks at all, have very little to no correlation in the broad markets. And again, I'll go over those. And keep in mind that I also you guys have noticed an emphasis, or at least somewhat of an emphasis, on commodities lately, such as soybeans, or actually, what was it, cocoa, wheat, things like that. And again, commodities, especially grains, agricultural commodities, have very little, if any, correlation to the broad stock market. So there's another way to hedge or diversify your portfolio by going long the best, most attractive looking setups, whether they are individual stocks or commodities, gold, precious metal, whatever it is. There's a lot of various asset classes out there, bonds, fixed income. You don't have to trade the stock market. And there are times where I think it's better to look elsewhere, even if the trend is up again, just because of the fact that the risk reward is not favorable. All right, enough on that. I wanted to again share and try to impress upon the point that if you're trying to fight this market on the way up by shorting only the broad market or only one sector or anything else, the key to trading is it's no different than investing. It's diversify, diversify, diversify. Don't put all your eggs in one basket. That means not just having 6 or 7 or 12 or more positions. It means those positions should be in different sectors of the market and different stocks with very low correlation or overlap. All right, so now let's get into the charts here. We'll look at the SPY. I've been stating for a while now I wanted to see this trend line break, this rising wedge, this uptrend line. Pretty impulsive breakdown. So the SPY, that was pretty much the last of what I've been waiting for here. The SPY is on a clear sell signal. There's a most recent divergent high, the extreme overbought readings, everything I've talked about in the past. I'm not going to spend a lot on this chart. I've updated the broad markets on the daily and 60-minute charts a lot recently. This minor uptrend line, we had a breakdown, back test, prices move lower. We're at support right now. Coming down for a while now. My first target was this uptrend line, this yellow uptrend line. You can see it goes back even farther, all the way back to this point here when I go out to a 120-minute chart, back to the 60-minute chart. That now would just be a bump along the road. Based on the scope of these divergences, I do expect that trend line to give way. It is a pretty significant trend line, so probably a reaction there. Just as we're at support right now, see that any line on the chart that I have is support if below current prices, resistance if above. So 235.10 where we're trading right now, we're at 235.14. We just bounced off the 235.10 level. There's a gap there and some reactions. But I think once this sell-off gets underway, I'm expecting or very, very, very much open to the possibility of a waterfall sell-off. Valuations, bullish sentiment, short interest, all these things have reached extreme levels where you don't have an orderly sell-off. You have a quick rush for the exits once it's become clear to all, especially the momentum players, that the momentum has now swung to the downside. So we may smash through some of these early support levels, and that wouldn't surprise me one bit. My point to that being that I don't care to take profits. I do still have, as I've talked about for weeks now, shorts on both the Qs, the NASDAQ 100, as well as the small caps. Not shorting the S&P 500 right now for reasons that I hope to get into in this video if there's enough time. There's a daily chart of the Qs, big bearish rising wedge, these yellow lines. I've been highlighting this minor uptrend line, which shows well on the 60-minute chart. We recently broke down, hit the top of the wedge, and now we're moving down pretty impulsively. And so far today, you can see this nice bearish engulfing candlestick. That means it engulfs the previous days. Actually, in fact, it engulfs at least the previous 2 days candles. Possibly that one there. I'd have to look at the highs. Either way, it is definitely a bearish engulfing candlestick. And when you have one of those at near the top of an extended uptrend, particularly if there's downside follow through the next day, that is a high probability reversal candlestick. And again, by follow through, I mean assuming this closes. Anything can happen. I'm doing this video, it's only 11:17 a.m. Eastern time, so there's still plenty of time in the day for the markets to rally back up, and therefore we would not print a bearish engulfing candlestick unless we close below yesterday's lows. I think it'll happen. I'm seeing a lot of breakdowns, and again, additional confirmation will come if we close below wherever we close today, assuming that this bearish engulfing candlestick does print that way, meaning below yesterday's lows. All right, hope I didn't confuse you there. So there's the Qs. I don't see any decent support until the bottom of this wedge, guys. So that's a drop of, just from where we're at now, from current levels. And what I'm doing is I'm going forward in time. We're not going to drop there in one day. Anything's possible, but we'd hit circuit breakers before that would happen. So let's just say it comes down here and it takes us, if you look to the pop-up box to the left, that's about 9 days, and that's about a 5% drop. And that would be my minimum target there, or downside call for the Qs. I already did. No, I didn't do the 60-minute chart. Rising wedge, divergent high, breakdown back test. Some minor support. I need to move this line. Let's move that line right there. This is a level to watch. I'll give you a number on it, 130.18 or so. Quite a few reactions, a little gap back there. Watch that level, 130.18, give or take a few pennies goes. The next stop would be 127.50. And then any of these are still my downside targets on the Qs. I've had these up for a while now. So there's QQQ. And finally, I'll skip the mid caps for now, just keep this thing short. Here's IWM on a daily chart. This one has had for a while now confirmed negative divergence, meaning we had a bearish crossover, put in a lower low on the PPO, the MACD, the RSI. Nice rising wedge breakdown, and pretty impulsive move down today, 2.13%. S1 goes, lights out for the IWM, in my opinion. That is a very solid support. Look at all these reactions. In other words, I'll box it and shade it to kind of show you what I see. When I look at that, I see a trading range now that's gone on for months, all the way back to November, sideways trading range. If we break below there, again, lights out, and I see a move down to no less than this T1 level at 125.66. That's T1 meaning first target, S1 just meaning support 2, support 1. So when support 1 breaks, we'd run down, I think, to S2, something along these lines. I'll draw it out for you. Quick move down, hit S2, maybe a little reaction there, maybe not. Again, there's a lot of pent-up energy right now in the market. VIX is at extreme lows, short interest is low, bullishness is rampant right now, and so we could see a pretty swift move down. And again, this would be my first target where I'd expect a decent reaction there, 125.66. To quantify it, from where we opened the day today, that's a drop of 9%. We're down 2% already, so that's about another 7% or so drop. 60-minute chart, there it is. I've covered this extensively on the front page. You guys know what I've seen. Here's that multi-month trading range right here, bounded by this SR support resistance zone. That's what that means, SR support / resistance zone. We went right up to the top of it. You can see the reaction back here. Failed, came down very impulsively. This is the definition of impulsive selling. Look at this, just wiping out. Today we're wiping out that rally that took a few days to get up there. There's the bottom of the zone. So that's that. All right, let's move on now to, wanted to cover sectors. I beat the bearish drums for a while in the semis, but I've made it very clear until we see these wedges go. I put up an update on the front page yesterday, so I'm not going to get into that now. Take a look at that. There's three I follow: XSD, SMH, and SOXX. Once we see them all break down, semis are going to have a lot of meat on the bone, in my opinion. But with that being said, one that already did break down, and I put as an official short trade because it did, is XLF. I mentioned this is probably right up there with, it certainly is my single most favorite sector. It's the only, if I'm not mistaken, the only official short trade. Shorted this one when the wedge broke down. There's an errant little spike on the candle there, but point is, you can see we followed through every day since the breakdown of the wedge. Red, 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 big red candlestick down 2.27% today. So, if you, and again, on these, you can use these leverage ETFs because my expectation, now that everything's cracking, is for a swift move down. I don't think this is going to be an orderly sell-off. Maybe it is, maybe it's not. But when you go with the leverage ETFs like FAZ, FAZ, you can actually do better than 300% the returns if the move is impulsive and straight down with very few givebacks. In other words, very few green candles. So I talk about that in the FAQ section. I avoid the leverage ETFs on long-term swing trades, especially if it might be a grindy, choppy move. But in a unidirectional move, a straight swift sell-off, you can actually that three-time leverage can work in your favor, and you can do better than 3 times the index. But again, I keep it simple now. I'm not going to put the 3 times on it anymore as ETFs. I'm sorry, as official trade ideas. You guys make your own decision whether you want to trade those or not. I'll just put on the one-time ETF. That's what I use to track the charts. And if you want to lever up, that's your thing. You just have to make an adjustment to your position size. I really can't advise you what to do, but just wanted to share that my thinking there. So this, again, one of my favorite sectors. There's the measured target. I've already covered this in video format and on the static post. It goes right down to the 2109 area. And what I wanted to do while we're here, I started with XLF. I just want to make the case for a correction by going over my sector holding. These are all the sectors within the S&P 500, each individual sector. And I did this recently, so we're going to go through this one by one very quickly. XLF on a clear breakdown with follow through. There's I guess anybody can argue anything they want, but to me that's a breakdown, and we're heading lower in the financials. XLE. We have a pretty well-defined trend line here. We've broken below. We're not moving down very impulsively yet, but we could, especially if we take out the recent lows. But there's a breakdown of a fairly well-defined trend line. Again, these are the sectors within the S&P 500. XLV, healthcare. What I see when I look at this chart, I see a series of trend lines. Fairly well-defined trend lines. This one goes off to the left of the chart. There's more reactions, but I see breakdowns, usually a back test, and then corrections. Breakdown, back test, correction. Here's a wedge. It broke down. We back tested, high-level back test right here, and I have a little minor uptrend line, and then correction. Trend line, breakdown, correction. Uptrend line, breakdown, back test, and probably a correction. So that's 1, 2, 3 of the sectors so far that to me have a bearish outlook. When this guy breaks, the market breaks. XLK is the NASDAQ 100 essentially. I mean, it's so tech heavy. Technology has almost single-handedly carried this market now for weeks here. And here's a bearish rising wedge pattern. Very clean, well-defined, numerous reactions. We're cracking through it right now as I speak, so let's see how we close the day. Anything can happen. The day is young. But there's a bearish engulfing candlestick. You see the size of that candle engulfing the previous 2 days' action. Again, how we close is the most important thing. And again, how we follow through tomorrow will and the next day will be important. So Xlk technology sector, I think when this cracks, there's a lot of hot air to be let out. I see a move down here to about the 48.50 area. We're at 53 right now. So you're looking at a drop, in my opinion, in the coming weeks of about 9% in technology. XLY, consumer discretionary. Keep in mind the theme here, guys. As I go through these, I'm going to get to the more defensive issues. You're going to see they look a little better. Again, I'm going through all the sectors in the S&P 500. Consumer discretionary, as the name implies, this is when you have discretionary income. When you're killing it, when you're getting bonuses at work, everybody's employed, you go out, you buy a Ferrari, whatever, discretionary income. That broke down very impulsively today. This is a very clean bearish rising wedge pattern, and that is a very impulsive, clear breakdown. And I think this one's coming back down here at about the 81, 87 level. We'll call it 82. So you still have another 5.35%. And that's not a good sign for the economy to see consumer discretionary break. XLP, consumer staples, looks a little better. Here's a trend line, not the most well-defined, but this one's still in an uptrend. I wouldn't short this one. Other than it was recently overbought, I don't see a divergent high. It didn't even make a double top high yet. If it made a marginal new high, and it could do so, but this is where, and I pointed this out recently, the theme that I'm seeing is a flight to safety, defensive issues like consumer staples. These are things like toothpaste and stuff that you need, staples. Same with utilities. I mentioned this before. During a recession or tough economic times or a downturn in the economy, or even a pullback in the stock market, you usually see a flight to safety in utilities because you don't stop paying your electric bill or your water bill. That's the last thing you cut back on. You cut back on the discretionary spending first, and the last thing you do is stop paying your water bill or your heating bill. So there it is, and that looks good. That's where money's been moving into, and I don't see any reason to short this one. The institutions have been buying it. Maybe it goes down. Sometimes in a swift broad market sell-off, everything falls. But the theme is that these defensive issues are holding up. Here's the industrials. Look at there. There's a nice breakdown. Bearish rising wedge, breakdown. So you can see the theme here are the economic sensitive sectors right now are the ones that look the most bearish. And XLB, basic materials, bearish rising wedge, breakdown, hasn't really done much yet, but again, it has broken down below that bearish rising wedge. Telecom, XLT, had a funky little candle yesterday. This is a thinly traded ETF. I just use all the spiders ETFs within there because they are the S&P, it's the S&P telecom sector, so it will most likely mirror the telecom holdings within the S&P 500. There are some other more liquid telecom ETFs. So again, disregard that spike yesterday. I think that was an erroneous print. You look at the 1 minute, look how thin this thing trades. See, this is a 1 minute chart going back a couple days. Therefore, you get somebody puts in a market order. If you don't know what you're doing and you're trading stocks and you put a market order on a thinly traded ETF or a stock like this, if it's trading down here, they can fill you wherever they want. So always use limit orders, and you can see that one little order up there. Somebody probably put a market order to buy and got smoked on it. So therefore, that created that big red candle right there. But again, that was what I call a false print. So what I see here, enough explaining, when I look at this chart, I see a divergent high. You see the negative divergence. In fact, we've had long building negative divergence for a while now. Most recently, a divergent high right here. We broke down and back tested. Again, I exclude that little print up there that made that candle big. So this one's basically broken down. We have 1, 2, 3, 4 reactions in a back test. And so if you ask me where I think telecom's going, I think we fail here on the trend line. Need an arrow tool and come down to any of these targets and maybe all the way down here. One more, real estate, XLRE. This is the Spiders XL REIT. We also have IYR. That's the more popular, more liquid, more actively traded one. And here's what I see. I see an ascending price channel. Fairly well defined, a breakdown. We hit support, bounce, and we're back testing. So we're at dual resistance, both this back test of this uptrend line as well as this level here about 78.76. You can see a lot of reactions to the left. As I go to the left, all these reaction all the way back here. So there's an ETF or a sector at dual resistance levels, likely to pull back down. And if it takes out this support level, this line here, could get ugly. Well, I don't mean to go down that far, maybe down to this level here. Okay, so as I mentioned before, I would talk about some of those the longs that I have been trading, and again, I'm quite bearish, so I've been quick to take profits. Like GoPro, this one was mentioned in the trading room. It still looks good. It may need another thrust down within the wedge. GoPro was posted, and I did very well on this one. It was, I think it was around 724 or so, and it was about a 20% gain or so. Yeah, right there, about 20% gain. I posted in the trading room around 724, something in there. Posted this being my target 862. We hit that level. We hit it again. And we pulled back. The reason I'm highlighting this again, this is an obscure stock. It's not. There's very little to, if any, correlation to the broad market. It's been in its own bear market for a while, but the daily chart is setting up with this bullish falling wedge pattern, a downtrend line. You might be able to adjust this trend line up a little. See right here, it starts back here if we get a reaction. So there's one to watch, but again, it may need to work its way down. And with the broad markets breaking down, I would be very, very selective in taking longs unless they have absolutely no correlation to the broad market, like this USRM. This one was good for, oh gosh, I think it was first posted at 4 cents a share, went up to, I'm sorry, 0.004. We had like a 1,000%, over 1,000% return on this, and then I posted it again in the trading room as an entry over 60 cents. Even from there, I'm sorry, 0.006. Even from there, it was good for about almost a 900% gain, and then I posted. After taking it there on the break above 60, selling it at that third target, and you can see beautiful pulled back, flagged, a little bull flag action. It's been moving up, and if it takes out that previous reaction high, this one can run. And I'm highlighting this because this is a penny stock. This stock is trading at 4.3 cents a share. This stock has virtually no correlation to the broad market. And in fact, it's when I see the broad market correcting, it's usually these low price penny stocks that tend to do well. But again, very aggressive. Read the notes on it, especially if you can get into the trading room if you're a gold member, a free trial member. Another one, for example, Cannabis Stock that I mentioned on the pullback to $2 recently, and it already popped about 20%, I think, from there to the bottom of the wedge, 14% or so. I'm just trying to give it a rough estimate. So this one's into this green line and this downtrend line make up a descending triangle pattern, and so you want to watch for a breakout of that, and that can run. And again, the cannabis stocks have absolutely no correlation to the U.S. broad market, so these are I'm trying to give you guys ideas on the long side. I mentioned cocoa. Another example of something that has nothing to do with the broad market and just beautiful price action, breakout of this bullish falling wedge pattern, bull flag pattern right there. We broke out and as expected punched up, hit the second target today where I said that's the first place I expected a reaction. I didn't think we'd get one at T1 because of the bull flag breakout. So a little reaction so far going on. You can see the doji setting up right on that the actual resistance level I have, which is 2686. I always set my price targets a little below to avoid missing a fill. But over time, I still think this one heads up to at least that 2870 area. The actual resistance line's at 2881. What else? A couple others. Wheat's acting a little soft today. I think the stop set at 680 if I recall right. It hit a low of 694 so far, so keep an eye on it. Wheat was another good example. We had a great run. We took it up. It was a breakout of this bullish falling wedge pattern. Hit my third and final target almost to the penny. You can see the actual resistance lines at 770. You can see it just hit that level and reversed. This is why I have final targets. Those are levels where I expect a trend reversal in most cases, or I see very little potential reason to hold the stock anymore. So we were able to exit. We recycled in just recently. That the swing trade was closed. It's still a long-term trade with this long-term target. And again, just watch it. If it goes under 680, let it go. We can always go back in if it gets back above this level. But again, I'm just making a point of these are the obscure stocks, or well, in this case, a commodity that's just not related to the broad market. Here's an example of a short trade. Shorted this one. I had a price alert this morning. I got the chart out as soon as I could. I was able to short this one right after the alert, and look, we're already down almost 5% on the day. And okay, there it is. I mean, not much else to say. First target, where I expect a reaction, little bounce, and then I think we're going down to that second target. So li.v, and oh, that was a short, by the way. Most of these I'm covering are long, potential longs. li.v, here's a obscure little penny stock, American Lithium Corp. I think they also have, I put up a chart. There's also some, you can buy this stock if you guys can't trade on the Canadian Venture Exchange, American Lithium. There it is. There it is. LIACF. For those of you guys that prefer to trade a bulletin board or over-the-counter stock here in the U.S. And let me get back to the other chart because that's where I was starting tracking. Somebody asked my opinion on this one, so I have a clean chart here. Bullish falling wedge, breakout. Here's horizontal support right here. You can see some reactions there, reactions back here. Divergence confirming the wedge. So as long as that one holds up, doesn't go much below that $16 area, it may want to go in for a back test, but I still think it looks good here, especially if it reverses off that level and takes that. And this should have no or very little correlation again to the broad market. So I'm trying to share some longs. The ones that stand out to me. Xlk, I mentioned this one many times in the trading room. Personally have a position, and most of these that I've covered have positions or recently closed positions. I'm using examples of some of the low correlation stocks to the broad market. Xlk, bullish falling wedge, confirmed with positive divergences, breakout. We need to get above this level. I showed you a 60-minute chart. Again, you can just use the search tool function on the top of the site, the search bar, type in FCEL, and you'll see the previous post. Was able to recycle out of that one and back in. I have just small position on these low price stocks, guys. Don't put much into it. You can put, depends how much money you have, few $100, few $1,000. You don't put much more than that. And you don't need to, because these are stocks that are going to go up 200, 300, 500, 1,000%. So it doesn't take much to have a decent dollar gain on it. But if they go the wrong way on you, and they can, and they sometimes do, you won't get burned. Cara has just been a gem. Started buying it back here. A lot of updates on this one along the way. But most recently was a short when it hit my final target. This final target was added back here, many percentage, 200-300% ago. Hit that target, reversed, mentioned in the trading room. There was support at the 1444 area. We hit that support, bounced, back tested, and we've rolled back over. I still think it goes down and at least hits that 1444 area again. I'm still short. I'm looking to get long if it gets back to 1335, possibly, depending on the chart. So again, Cara, here's a stock that marches to its own drumbeat, could care less what the broad market's doing. And that's an example of what's going on. All right, let's wrap it up here. I do have some indicators I was going to show you, such as a percent of stocks trading above their above or below their 200-day moving average or the 50-day moving average. The NASDAQ advanced decline line, things like that show market breadth deterioration. I've talked on that recently. I can just tell you it's there. And again, the point that I pressed earlier in the video is when you have that deterioration in market internals, such as we've had recently, there are still plenty of shorting ops out there, even if the broad market appears like it doesn't want to roll over. You just have to be selective. Don't short the SPY or you're going to be frustrated. Because the SPY, as I just went over with all those sectors, you're shorting utility stocks, defensive issue stocks, high dividend paying stocks. If you're new to trading, I understand not wanting to short individual companies because you could get burned on an earnings or news-induced gap. But there's a lot of ETFs, like I mentioned. Financials, one of my favorites. Semis are right up on deck ready for a breakdown. And I'm sure there's more out there. So as I find them, I'll post them either as unofficial trade ideas or official trade ideas for you. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.